October 29, 1929. Black Tuesday. In just one single day, the United States stock market lost $14 billion. That is more than $200 billion in today's money. Fortunes vanished. Millionaires became paupers overnight, and the event triggered the worst economic disaster in American history. But here's what most people don't realize. The crash didn't happen by accident. It wasn't a random event. It was the result of lies, unchecked greed, and a financial system that had been ticking like a time bomb for years. So what really caused the 1929 stock market crash? And why didn't anyone stop it before everything collapsed? To understand what happened, we need to go back a few years earlier, to a time when America was booming, confidence was sky high, and everyone believed the good times would never end. Welcome back. Today, we're diving deep into one of the most important moments in financial history, the 1929 stock market crash. This wasn't just a bad day on Wall Street. It changed America forever. It wiped out life savings, destroyed businesses, and pushed the entire country into the Great Depression. But to understand how it all fell apart, we have to start in the early 1920s. World War I had just ended. America emerged stronger than ever. Factories were booming. New technologies were transforming daily life. Cars, radios, electricity, and mass production changed how people lived and worked. Jobs were plentiful. Wages were rising. And for the first time in history, ordinary Americans began investing in the stock market. Before this period, stocks were mostly reserved for the wealthy. But during the Roaring Twenties, everyone wanted in. Your neighbor, your barber, your teacher, even your taxi driver were buying stocks. And why not? Prices kept going up, month after month, year after year. It felt like free money. Major companies like General Motors, RCA, and U.S. Steel became household names. Their stock prices doubled, then tripled. Some people quit their jobs to trade full-time. They believed they had discovered the secret to easy wealth. But beneath the excitement, there was a serious problem. Most investors had no idea what they were actually doing. And even worse, they weren't using their own money. They were borrowing it. This brings us to one of the most dangerous practices of the era: buying stocks on margin. Buying on margin meant you only needed to put down a small fraction of a stock's price, sometimes as little as 10%. The remaining 90% was borrowed from your broker. For example, if a share cost $100, you only needed $10 of your own money to buy it. If the stock rose to $150, you made $50 on a $10 investment. That's a 500% return. It sounded incredible, but there was a catch. If the stock price fell, U.S. Till owed the full amount of the loan, and your broker could demand that money back immediately. This was known as a margin call. If you couldn't pay, your broker would sell your stocks at whatever price they could get. And if prices kept falling, you could lose everything. By 1929, margin debt had exploded. Billions of dollars were loaned out to buy stocks that were already massively overpriced. The entire system was built like a house of cards. And almost no one wanted to admit it. Not everyone was blind to the danger. Some economists warned that stock prices had become disconnected from reality. Company profits weren't keeping pace with stock valuations. The math didn't add up. But their warnings were ignored. The media continued hyping the market. Banks encouraged people to borrow even more. Influential figures claimed the economy had reached a permanently high plateau. They truly believed the boom would last forever. Still, there were cracks forming beneath the surface. In early 1929, the Federal Reserve began raising interest rates to slow down speculation. Borrowing became more expensive. Some investors grew nervous and started selling. But the market kept climbing. Until September. In September 1929, the stock market reached its peak. Then it began to wobble. Small declines appeared. Nothing dramatic at first, but confidence was starting to fade. Then came October. On October 24, 1929, panic exploded. Black Thursday. The market opened, and investors rushed to sell. Prices collapsed. The ticker tape, the machine that displayed stock prices, fell hours behind. No one even knew what their stocks were worth. Chaos filled Wall Street. By midday, powerful bankers stepped in. Firms led by J.P. Morgan pooled millions of dollars to buy stocks and stabilize prices. And for a brief moment, it worked. The market recovered slightly. People breathed a sigh of relief. Many believed the worst was over. But fear had already spread. That weekend, newspapers ran alarming headlines. Investors couldn't sleep. And when the market opened again on Monday, the panic returned. October 28, Black Monday. The Dow Jones Industrial Average dropped 13% in a single day. It was the worst one-day loss in history at that time. But Tuesday was even worse. October 29, 1929. Black Tuesday. 16 million shares were traded in one day, a record. Brokers were overwhelmed. Margin calls flooded in. Investors couldn't pay. Stocks were dumped at any price. Fortunes evaporated. A millionaire in the morning could be broke by lunchtime. There are stories of investors jumping out of windows. Many of those stories were exaggerated, but the despair was very real. Families lost everything. Businesses collapsed. Banks failed after lending money that would never be repaid. By mid-November, the market had lost nearly half its value. And the decline didn't stop there. The market wouldn't hit bottom until 1932. By then, stocks had lost almost 90% of their value from the 1929 peak. The crash didn't just hurt Wall Street. It destroyed the entire economy. Banks closed. People lost their savings. There was no deposit insurance back then. If your bank failed, your money was simply gone. Unemployment skyrocketed. By 1933, 1 in 4 Americans was out of work. Factories shut down. Farms failed. Families were evicted. Bread lines stretched for blocks. This was the Great Depression. And it lasted for an entire decade. What caused it? Overvalued stocks, reckless borrowing, weak banking regulations, and above all, greed and overconfidence. People believed the market could only go up. They ignored risk. And when reality finally hit, the system collapsed. After the crash, the government stepped in. New rules were created. The Securities and Exchange Commission was established to regulate the stock market. The FDIC was created to protect bank deposits. Margin trading was limited. These reforms helped prevent another disaster like 1929. But the deeper lesson remains. Markets are not magic. They are driven by human emotion, fear and greed. And when everyone believes prices will rise forever, that is usually when danger is greatest. The 1929 crash wasn't just history. It was a warning, a reminder that bubbles always burst, that borrowed money magnifies risk, and that when something seems too good to be true, it usually is. Today, markets are more regulated. Protections are stronger. But human nature hasn't changed. Greed still exists. Fear still spreads. And history has a way of repeating itself. The people who lived through 1929 learned these lessons the hard way. We don't have to. Understanding what happened back then helps us make smarter decisions today. Whether you're investing, saving, or simply trying to understand how the economy works, the lessons of Black Tuesday still matter. If you found this story fascinating, make sure to subscribe. We break down financial history every week, exploring the moments that shape the world we live in today. Leave a comment and let me know which financial event you'd like to see next. Thanks for watching. I'll see you in the next video.